Good morning, good afternoon, and thank you for joining this Morgan Stanley Derivatives call, our second of the year. As a reminder, this call takes place every 2 weeks. It takes 15 minutes, and follow-up notes will be sent to all of those who dialed in. I'm delighted to be joined today by Andrew Sheets, our Global Head of Fixed Income Research. My name is Rob Cronin. I run our European Derivative Strategy team here in London. We have a lot to chew through in the next 15 minutes. I'm conscious that we have President Trump speaking at 1:30 in Davos, so keen to jump right into it. Before I do, just a quick note. Myself, Rob Cronin, I'm not a member of the Morgan Stanley Research Department. My views are my own, and they may differ from the Morgan Stanley Research Department. Please note this call is for Morgan Stanley institutional clients and employees only. Please also note that this call is not for retail and wealth management clients. Please see Morgan Stanley website for other disclosures. Andrew, I'm going to come to you first. I know you've got a lot on, and certainly as we head to 1:30, markets are no doubt going to be ferocious. You've been around a while, Andrew. You've recently taken over the seat as the head of global fixed income research, so congrats on that. Can you just give us a quick two-minute summary of your view on the state of the fixed income market, what you think the most likely path is for rates and the shape of the yield curve as we head through Q1?
Yeah, thank you. Thank you very much, Rob. So I think the thing to keep in mind is that markets are operating under this unusual confluence of easier monetary policy, easier fiscal policy, and easier regulatory policy. And for equities, especially for U.S. equities, we at Morgan Stanley think that that's a supportive factor. But this idea that policy is going to be supportive, and this is a global theme, fiscal policy is easing in Japan, fiscal policy is easing in parts of Europe, does raise some more uncertainty around the government bond market, where you both have supportive factors at the front end with central banks that might continue to cut rates, and we at Morgan Stanley think they continue to cut rates, but potentially easier fiscal policy and the potentially kind of higher growth and inflation that all of that policy support produces, leading to higher rates at the long end, which represent more of that longer run future. So, we think that this is very consistent with a steepening of the curve. That is our view across regions, across the U.S., Europe, and Japan. But I think that this is also one where you have a lot of moving cross currents. So, maybe just in terms of things that we're watching for what causes a rate move to move from a more, kind of reasonable move based on, some of these factors to something that investors would be more worried about. One would be levels of rate volatility, implied rate volatility. Those ticked up a little bit yesterday, but still remain quite low. They actually remain kind of certain measures in the U.S. remain lower than they did at the start of the year, and they remain lower than they were a year or 2 years ago. So we haven't really seen a big move in implied rate vol. I think investors are also very focused on inflation expectations. Do those start to move in a more significant way? Now, again, inflation expectations, they've moved up a bit since the start of the year across the G3, but they still remain pretty close to central bank targets. So in short, I think some important things we need to watch. I think we remain in the camp that curves are more likely to steepen and flatten, but certainly a lot of moving parts we need to watch. Maybe Rob, I'll pass it back to you.
Yeah, super clear. And I'm going to fire 2 quick questions at you, Andrew. You can answer in quick succession. First up is your headlines for Fed permutations this year. Obviously, that'll have a big say in matters. And second, if you can just touch at a very high level on developments regarding Greenland and what you think the most likely path is there.
Yeah, so I think we might get more information around Fed leadership soon, and again, I think markets have been kind of waiting around for that. I think investors have some views about what they think will happen, but I wouldn't say investors feel a great deal of uncertainty, and views around who the so-called front runner is have moved around. You also have, today some potentially important information There's a case in front of the Supreme Court that relates to the U.S. administration's desire to remove Lisa Cook from the Fed. That we might not get a ruling on that case for a while, but it's possible that the justices' questions would indicate their views around the case. And I think bond investors are watching that very closely for thoughts around how the Supreme Court views the executive branch's power around Fed appointments and the like. As it relates to some of the headlines, the geopolitical headlines, again, I think this is another uncertainty that's been thrown into the mix. I think investors are genuinely kind of uncertain around what ultimate kind of aims and objectives are here. I think, again, if you think about the way the markets have moved, I don't think we've seen anything in rates markets or currency markets that suggest a major a shift in how markets are perceiving the status quo versus a month or 2 months or 3 months ago. But it's a big area of uncertainty, and we might get some more clarity around it. And again, I think it's also very important around this issue to look at what do we hear from senators in the U.S. They may want to have a say around any significant shifts in U.S. foreign policy, and also what does public opinion polling say? Because again, as this shows up more in the news, you could get a much better indication over how popular or unpopular this is among the public, which matters going into a midterm year. So with that, Rob, I'll pass it back to you.
That's great, Andrew. Really appreciate you joining, and those comments will be summarized and synthesized for those who dialed in, notes to come after the call. Thank you for joining, Andrew. Moving back to equities, if we sort of treat what's happening now as somewhat of an aberration for the moment, something that we will ultimately, a wall of worry that we will ultimately climb, I think there's a lot of leads in what happened in the first 2 weeks of trading that tell you where investor sentiment, not just at the margins, I would say, but at its core, is shifting. It's been by any measure, a ferocious start of the year for European equity participation. For those of us in the moving business rather than the storage business, it has been a strong start. The volumes have been exceptional. If I look at single name call options in Europe, we have traded double the typical year-to-date average to this point. It's about 40% stronger than the previous high. If I look in cash equities, we're about 80% higher than the kind of 5-10 year average year to date at this point. And you see something similar in index calls, not quite as strong, but certainly in the same postcode. Up until last week, if I take a kind of a 4 or 5 week window, that is from the middle of December through kind of the second week of January, again, the numbers are actually quite extraordinary. It was the most bullish quarterly roll for Euro Stoxx index futures we've had in 19 quarters. That is, we had about 100,000 more longs rolled than shorts covered, about, call it $7-8 billion worth. We since then had about $60 billion about 60,000 contracts, or another roughly $4 billion bought, so that the net position has shifted about 30 percentile points, which is no mean feat in a very short space of time. Similarly, you see in the option market, we had, as people prepared books for Q1 26, we saw a material improvement in the short-dated option flows for Europe, about $2.5 billion of put gamma sold and call gamma bought up until the beginning of last week. And on the cash side, it was more a story of short covering rather than longs being added. There wasn't so much rotation, I would say. It's been very much a continuation of the momentum trade. And you see that very clearly as well, with momentum breaking new highs pretty much every day for the last fortnight in Europe. I think it's important as well to note just how narrow the market's been. Year to date, we've only had about 35% of the Stock 600 names outperforming the benchmark. If I look to the US, that number is about 62, 63%. So in the US, I think we can say with a high degree of certainty broadening out is a theme. It is not a theme in Europe. And one of the reasons for that, we believe, is that there is still enough in the rotational trade into Europe on a global scale that people don't really need to delve into the belly of the index, or maybe focusing on small or large caps, mid caps and small caps that they're doing in the US. Also, I would say, US growth GDP will likely outperform Europe this year. If I look at our numbers, about 1.3, 1.4% stronger. So question marks around if the level of growth we have is actually high enough in Europe in real GDP terms or nominal to sustain a broadening out rally. Europe at the moment, if I look at our prime book, we've got about 16% of our global gross leverage is deployed in Europe. That would be about 13th percentile. At its peak last year, we reached about 55th percentile. So we're still really low in terms of overall allocations to Europe. And the money flows we've seen have been attracting a bit more into the kind of well-known underperforming names in Europe relative to global peers. It's also true, and if I look at my comments on the single stock call volumes earlier on, we've seen very strong performance of single name vols year to date relative to index vols. A very low implied Corel among the single names as a result. And I think one of the reasons for that is, we started the year with some extraordinary moves, things like ASML up 12% in the first 2 trading days of the year, other large names like your Rheinmetall's very strong performance as well. And it reflects kind of the narrowness of the market, also kind of maps neatly onto how well some single stock falls have been trading, particularly in the Eurostock 50 names. If you take the top 10 names in the Stock 600, they make up 13% of the market cap weight, yet at its peak this year, they represented 70% of the index point game. So a narrow market in Europe, and we think people should really stick to that way of playing it for now, rather than focusing on the broadening out trade. In terms of overall levels of exposure in Europe, I mentioned the cash side, but also on futures, future gross leverage is only about 3rd, 4th percentile in Europe in contract terms. So, the amount of white space for leverage investors come back into Europe, and while the short-term bullish flows might have been very high, the amount of white space is very, very evident. Charts on this to follow up a little bit later on. I can mention a couple of themes that we're focused on still. Ones we think will struggle in the near term as a result of this kind of ongoing tariff debate, and maybe a single stock ID as well as something on index. At the theme level, we think the powering AI story will trade very well through the first 3 months and 6 months of this year. There's a major re-rating still to be done. Shorts have come down massively. About half the short base has been taken out in the European powering AI data center story, but it's now transitioning into more of a long play. But the gaps there are immense relative to what we see in the US. US story, the US powering AI story has been a trade for 9 months. In Europe, it's really only arguably it's sort of 1-2 months in. So we expect a lot more narrowing of that gap relative to the US. On the defense side, we're going to send out some content this afternoon on it, but it's had a very strong run. We think there's an argument to be made that under very conservative assumptions, price to sales ratio of 2.1, which is where we traded in February 25, mapping that onto how much revenue is likely to be generated for European defense companies in the coming years. We think that there's a kind of realistic scenario on very conservative estimates on price to sales ratio that we are currently implying about 2.9%, and to get to 3.5% of GDP spend would imply about another 30-35% upside. If you say that the price to sales ratio over the next couple of years is going to be more like 2.9, which is what the average was for 2025, then again achieving a 3.5% GDP spend would imply more like 85% upside. Details in the note to come a bit later on, but I think that's worth that sort of framework of analysis is worth keeping in mind. We also do like the global defense trade as the kind of militarization trade becomes more global. We have pockets of risk in Asia, Middle East, South America, as we've seen more recently. And the good news is that global defense trades about 10 to 15 vols lower than European only, and it's underperformed by about 200% on average over the last 2 years. So I think since March 22. So I think that's something worth looking at. Again, watch out for that note later on. On single stock side, we've been extremely active on ArcelorMittal. There is a major theme there with Mittal along European steel pricing. We think there's a path to the stock doubling in the next 12 months. The good news is that the upside skew is fully inverted now. So using that very expensive wingy call to fund things closer to the money is a very attractive trade. We've been super active in calls with knockout features or call spreads, and we've had a lot of people selling put knock-ins to fund upside as well. But that is our highest conviction single name ID on the desk. On the short side, luxury, we do think there is a chance for short-term squeezes through earnings season, but failing that, we would want to lean in on the short side. We also want to lean in short, continuing on the autos story. The cyclical and structural issues that the sector is facing are not going away. If anything, they're going to get worse in 2026. The short base is 2.8% of free float. Historically, it's been as high as 6%. And we think the sector, given that it's trading now at 9.2 times 12-month forward PE versus 5.5 times at its low last year. We do think there's derating risk there also. If you are looking for tariff-sensitive names, MSST USTF is our tariff basket. Again, there are a lot of things like autos, consumer names, luxury in there. That's well worth tracking as a barometer for the ongoing geopolitical risk between Europe and the US. Another thing worth keeping in mind is gold, silver. The vol spread there broke a new all-time high yesterday, close to 70 vols. So that is a trade that we are focused on. So for those who are looking for a rotational play, getting long gold options funded with selling silver options, the vol spread there is so high that the ratios you can get for call versus call are showing to be very, very high indeed. So we have a lot of people looking at that in the last 24 hours. And then very finally, on the index side, I can mention two trades. One is if you are looking to hedge at the moment, given that the term structure has not yet fully inverted, I think keeping quite short dated and spread format makes a lot of sense. The skew has steepened a lot. And I think something like an end of January, so a Jan 30th, January 30th, 98.5, 95% put spread for 45 basis points at 20 delta makes a lot of sense. You're really taking advantage of that skew steepening and reducing your Vega exposure. And if you are looking to play a bit more on the upside, then I think you go a little bit more longer dated, a la the kind of a potential tackle or off-ramp scenario at some point. Again, taking advantage of the fact that skew has steepened in short-dated space out to about kind of 3-6 months. So I think something like a March 93.5 put to fund a 103.5 call for about 25 basis points. I think that trade makes a lot of sense as well. I'm going to stop there. We've gone slightly over the half-hour mark, conscious that we're heading towards the 1:30 and the Trump speech in Davos. Thank you all for joining. Follow-up notes to come within the hour, and we hope to see you all back here again in 2 weeks.